we're likely to see a market correction in 2022. The Fed is beginning to taper.
Which is reducing its bond purchases, and that's going to likely be done here in the next couple months.
Which will cause interest rates to move up, kind of moving towards maybe that 21, 20, 18, possibly 17 if interest rates were much higher. I don't think we'll get there. So you could have that technical correction. A technical correction is 10% off of the high. And if they were to mess it up significantly, I would say bear market is not out of the realm of possibility. So we could be down to 37.91 off of that. But here's the thing: is we don't know what the high is going to be. As we're moving into an economy and the Fed is beginning to taper, a lot of people interpret that, probably rightly, that the economy is strong, that it's growing, that it's moving. So there are going to be people that are buying through this. It also takes time for the Fed to slow down its purchases before it actually starts to affect the broader market, specifically price values in the market. So let's say we're down 10%, but we had a rally the first couple of months of 12%. Well, if you were to get out just because you say, hey, the correction's likely, you missed out on 2%, even though you were correct. And in addition, a lot of that volatility is going to be caused by the Fed tightening, and they can just as quickly loosen. So if we do have a correction or even a bear market, we think it's going to be one and done and over pretty quickly. So we would see that as a buying opportunity. Now, we would not try to time it. What we'll try to do is dial back some of the risks. So if we were to have all-time highs in our portfolios, we'd see that as an opportunity to raise cash, especially for cash reserves and cash targets that we encourage clients to have, and put some of that money off to the side. And if we did have a correction, maybe even put some of that back in or just spend it down, knowing that we got a high in the market.